Hello kids, from this video I'm discussing 2023 first paper LL accounting from question number 1 to 50 with workings and discussions. So first question, which of the statements best describe the primary purpose of accounting? So it should be provides the information about a firm to the stakeholders for decision making. And number 2, which of the following accounting concepts provides the basis to classify assets and liabilities as current and non-current? So the correct accounting concept that should appear is going concern concept. Going concern concept mean we are doing accounts in relevant accounting entity that we are assuming the operations would be large for the foreseeable future without any interruption, right? Third one, which of the following accounting concepts provides the basis for the recognition of right of use of assets in the statement of financial position? So the correct accounting concept that I learned for here is substance over form concept. So always there are only one implication that we are talking about for the entire LL accounting syllabus for the substance over form concept. The only uh, implication, only the example that we are discussing is this recognition of right of use of asset in the SIFC. Okay. For transaction number 456, you have to answer by using this case study. So before you are reading into the case study, first of all, write down the questions. Fourth one, they're asking what are the source documents used to record transaction number 1, 2, 3 in the books of Mihiri's business. And this is the Mihiri's business. So Mihiri commenced that on 1st of Jan by investing this amount of money and furniture. And this business was registered for value-added tax. And however, assume that there is no VAT on purchases. So no VAT on purchases. So which means only VAT on sales. The following transaction took place during the month of Jan 2023. And these are the transactions. So from the fourth question, they are asking what are the source documents that to write down transaction number 1, 2, 3 in Mihiri's business. So transaction number 1, purchase goods costing 400,000 on credit from the Asian traders. So this is credit purchases. So the source document relevant for that is purchase invoice. And after that, you are returning back the stock that you purchase on credit back to your supplier. So that is return outward. So the source document that relevant for the return outward is debit note. And from the third one, you are selling your goods that were 250,000 for 345,000 in cash, inclusive VAT, blah, blah. So here you are receiving cash 345,000. So which means the source document relevant for that is a receipt. So the correct answer should be number 3, invoice, debit note, and the receipt. Fifth one, they ask me what are the primary books used to record the initial investment of Mihiri and the transactions number 3 and 5 in order of their appearance. So here in the Mihiri, she invested cash to the business. So investing cash, which means from the business point of view, it's receiving cash. So it should record under cash receipt journal. And then again, Mihiri investing 400,000 worth of furniture. So the property and equipment you have to record in general journal. So for the initial investment, it should be cash receipt journal and general journal. And then we have to come to the transaction number 3. So here you are selling stock on cash. So you are receiving cash receipt journal. And the fifth one, issued the check to settle the amount payable to the Asian traders. You are issuing checks, which mean the cash payment. So that should comes under cash payment. Answer should be number 4, cash receipt general journal for the initial investment, cash receipt journal for the third transaction, and cash payment journal for the fifth transaction. And sixth one, they ask you which of the following accounting equation reflects the net impact of transaction number 3 and 4 to the assets, liabilities, and equity. So the third transaction is sold goods costing 250,000. So your assets goes down by 250,000. And again, your assets should increase by 345. because you are receiving cash 345, but there are 45,000 VAT that include in that sales. So that sales VAT is a liability because that is a VAT payable back to the government. So that should mention under liabilities. So which means the remaining amount, the difference of stock and the VAT sales without VAT is your profit. And that profit you should add it to the equity. And the fifth transaction, you are issuing a check to settle. No, sorry, they are asking the impact of the transaction number 3 and 4. So the fourth one, sold goods costing 100,000 for 138,000 on credit. So here again, assets goes down by 100 and debtors goes increased by 138, and the VAT included in that sales, you should add it to the liabilities because it's a VAT payable back to the government. So which means your sales without VAT is 120. So you are selling 100,000 worth of stock for 120, and from that you are getting a profit 20. So that should add it to the equity. So the net impact on these transaction number 3 and 4 is assets increased by 133 and liabilities increased by 63 and equity increased by 70. Question number 7, they are given the draft of profit as 360,000 and they found two adjustments, two errors that they did. And then they are asking what is the correct profit for the year ending 31st March 2023. So here the profit shown in the draft financial statements of Samani PLC for the year ending 31st March 2023 was 360,000. So this is your draft of profit. And this is the profit that you should adjust by adjusting these errors. First one, the surplus of 120,000 resulted from the second time revaluation of motor vehicles during the year has been recognized as other income. That's totally incorrect because you have to recognize those revaluation surpluses in other comprehensive income. So first of all, that 120 you should deduct from here. And then, however, this surplus has been accounted without considering the revaluation deficit of 80,000. So you have to written off the revaluation deficit that resulted from the previous year from this year's revaluation surplus. So you have to written off the revaluation deficit from other expenses, so which means that 80 you should add it to the drafted profit, right? The maintenance expenses of the photocopying machine relevant for the current year 30,000 was paid on the 1st of April 2022 and it has been debited to the office equipment account and credited to the cash account. So that's incorrect because and the office equipment has been depreciated 20% per annum. So that maintenance expense, you can't record that maintenance expense in your photocopy machine. You are not adding that to the cost. You should consider that maintenance as a subsequent expense, so which means it is just an expense. So that expense you should minus from here. But the case is they added this 30,000 to the cost of the photocopy machine. So which means when they are finding out the depreciation, they also included that photocopy machine as well, right? So which means they did depreciation for that. Then you have to reverse back the depreciation. So depreciation is an expense, and when you are reversing back that, then that depreciation rate now you should add up to the draft of profit, right? So your adjusted profit should be 296. So the correct answer number 5. 8. Aruni Traders is a sole proprietorship, and then they are asking the gross profit and net profit. The gross profit and net profit is given here. Are they given? Yes. Before adjusting these cases, the gross profit is 150,000 and the net profit is 80,000. And what happened here? An inventory costing 20,000 was fully destroyed, and 80% of this loss reimbursed by the insurance company. no adjustment done, and then they are asking the difference that can be, right? So in these cases, you have to get the idea. Any changes that you made for the gross profit is similarly affecting to the net profit as well, because you are finding out net profit after the gross profit. But there are the adjustments that happen to the other incomes and the other expenses is not affecting to the gross profit. It is only affecting to the net profit, right? So here the stock damages is 20,000. So what's the double entry of stock damages? Cost of sales should credit by 20,000 because you can't use that stock for your sales. So it should minus when you're finding out the cost of sales. And if there are nothing about the insurance, so the stock damage should debit by 20,000. But what happened here? The insurance compensation is going to 80,000 for the damage. So which means the insurance receivable should be debit 16,000. So when the stock damages is debit 4,000, why is that? Because the total loss is 20,000, but from that 20,000, insurance companies compensate 16,000. So the expense that you should bear is only 4,000. Right? So stock damages you are recording in other expenses. So your net profit should minus by 4,000. And insurance receivable is nothing to do here because insurance receivable is an asset. And cost of sales credit by 20,000. So cost of sales credit by 20,000 mean your cost of sales getting down, getting decreased. So which mean your profit should be increased. So gross profit is increased by 20,000 and that's similarly affecting to the net profit as well. So net profit is also you should add a 20,000 back. So after you adjusting the stock damages with insurance receivable, the drafted gross profit is 170,000 and drafted net profit is 96,000. To answer question number 9 and 10, you have to read down this case study. From 9, they're asking what is the prime cost. And from the 10, they're asking what is the total manufacturing cost. And here, RLA PLC is a manufacturing business, commenced in operations on 1st of April 2022. The following information relates to the transactions occurred in business during the year ending 31st March 2023. And yes, cost of machinery purchase, and machinery purchase is not an expense that you should consider when you're preparing manufacturing account. But the depreciation of that machinery you should consider for the production overheads. So 8,000 divided by 10, the machine depreciation is 800. And the cost of raw material purchase you should add it to the prime cost. And direct labor cost you should add it to the prime cost. And the production overheads here after the prime cost. And what are the additional informations? 20% of raw material purchase remain as the inventory as in closing date. So from 5,500, 20% remain unsold, unused actually, because this is a production process and these are the raw materials. So the closing stock should be 1,100. And the work in progress 450 and work in progress value at prime cost. They are specifically saying that the work in progress stock you should value at the prime cost and it should minus from uh, prime cost at the end and fully destroyed 550 raw materials and that stock damages you should deduct when you are finding the raw material consumed. Then you can find out raw material consumed and that to that you have to add direct labor and minus work in progress and then you are getting the prime cost. And to that, the production overheads is given here, excluding machinery depreciation. And then you found out the machine depreciation at the beginning, and then you can find out the production cost. So your correct answer should be, for question number 9, should be answer number 1. Yes, answer number 1, and they are given the marks for answer number 2 as well. Okay. Because of that, for 50 million work in progress. Because in the syllabus, they changed that the work in progress you should adjust it after all the addition of the prime cost and the production overheads. But here they are specifically saying that the work in progress you should add to the prime cost. Right. ඒ දෙකටම ලකුණු දීලා තියෙනවා. And what is the total manufacturing cost? And it should be 9,000. So the correct answer should be number 1. And for question number 11 and 12, they given a case study and then the cost of sales they are asking and the net profit and the inventory as in closing date. So here this is a bit big question and this is given with a lot of informations and actually these are incomplete records. From adjusting these information you have to find out the things that you need, right? And then they ask in the cost of sales and then blah blah and the net profit and the inventory. So let's see. Property, plant and equipment is given at the carried amount. Inventories, trade debtors and trade creditors are given. The operating expense 250,000 allowed for the year ending has been paid in cash during the year. So there is nothing to do for that because there is no any balances that affect into the net profit as operating expenses. So that operating expenses directly you have to consider here as 250. And 3 million was collected from trade debtors and 2,500,000 was paid to the trade creditors and all sales and purchases are carried out on credit basis. So which means sales you should find from debtors control account and purchases you should find from creditors control account. Debtors opening and closing balances are given and the cash collected from debtors are given. So by adjusting these, you can find out your credit sales, which means the total sales as 3,500. And from the credit control account, opening and closing balances are given. And the cash payment to the creditors are given as well. Then you can find out the purchases. And yes, your purchases is 2,900. Okay. And 2,250 were purchased and there were no disposals of property, plant and equipment. So from the property, plant and equipment, you can find out the depreciation. So the opening property, plant and equipment is 3,000. And in the year you purchase 2,250. So 3,000 plus 2,250, 5,250. But the closing balance is 5,000. So which means the cost of difference is depreciation. So your depreciation is 250. And then they are saying the entity sells goods with a markup of 25% on cost. So which means when your cost of sales is equal to 100%, your gross profit is 25%, then your sales is 125%. So we already know this 3,500 is equal to 125%. So by dividing this 3,500 by 125, you can find out what is the amount that allowed for the 100%. So that is 2,800, right? So opening stock plus purchases is 4,700, but the cost of sales is 2,800. And the difference of those two is what? Your closing stock. And your closing stock is 1,900. So the correct answer should be, first of all, they are asking the cost of sales, right? So cost of sales is 2,800. And the closing inventory should be 1,900. And the net profit after deducting operating expenses and depreciation from the gross profit, your net profit should be 200. Right? So the correct answer for question number 11 is 5. And for question number 12, that is 1. Right? So when they are given an incomplete record question like this, you have to go with these workings and then you have to find out. Without workings, you can't do accounts. Right? So the thing is that you have to master, you have to do workings very fast. First of all, you have to think what is the working that suitable for this, and then you have to do that fast and then get the question. Because you have to answer 50 questions for 120 minutes, right? 31. Which of the following statements are correct as per the section 24 of partnership ordinance? All partners are entitled to share the profit or losses equally. Yes, it is. The retiring partner, darling, retiring partner, it's coming from section 42. Section 42 again, for the retired partner, you have to pay 5% interest per annum. But for the existing partners, it mentioning under section 24, right? So that's not coming here. Every partner may take part in the management of the partnership, but not entitled to receive an remuneration, so which means the salaries in this respect. So that's correct. So the correct answer should be A and C only. 14 and 15, you have to answer with these partnership question. Here, PL, Lal and Neil carried out the partnership sharing profit and losses equally. The balances of capital and current account balances as per the opening date is given here. And as per the partnership ordinance, so what they're asking the current account balance of PL, right? And to that, you have to do the current account. As per the partnership agreement, each partner is entitled to an allowance of 800. So the from appropriation account, you have to deduct that salaries and it should credit it to the each partner's current account and 10% annual interest of opening capital balances. So here are the balances into that 10% and again current account credit by capital interest and then PL has paid 300 for the current year expenses. Nothing recorded. So that payment it should credit to the current account of PL and that should deduct it from the draft of profit because those are expenses and you should adjust expenses whether you paid in cash or not. That doesn't matter. The partnership expenses paid by the partners. Whether an expense paid in cash or not or part of it, that doesn't matter. It should deduct it as an expense, right? So it should deduct from draft or profit and yes, that's it for that. So just a profit is 4,800. After deducting salaries and interest on capital, the profit that you should distribute for PL, LAL, and NIL is 1,200, and that should distribute equally because the profit distribution policy is equally. So 400, 400, 400 for PL, LAL, and NIL. Right? So that's it. Okay. Then you can find out the PL's current account balance as 2,900. So the correct answer should be fourth one. And then, after all, Neil retired from the partnership. So when the partner retiring from the partnership, the first thing that you should do is transfer current account from the capital account. So in this case, Neil is going to retire. So Neil's current account balance is 1,800, and that 1,800 balance you should transfer from current account to the capital account. And this is your capital account, the opening balances, and the current account balance that transferred from the current account to the capital account, and then you have to adjust the goodwill. And here the goodwill is given as 1,200. It should distributed equally because your old ratio is equally, and it should credited to the each partner equally. And then the new partnership profit share is also 1 to 1, right? And then which means 1,200 you have to debit to the PL's and LAL's accounts. Then you can find out the balance. Correct? But they are asking, yes, they are asking the capital account of PL and it should be 5,800 and Neil's loan account because you are transferring capital account balance as a loan account. So that should transfer to the loan account 4,200. You have to answer for question number 16 and 17 from this case study. And here they are asking the total income and total expenses first. So here the sales is given directly, that is total income, and other income given as 600, and the revaluation surplus from the revaluation of machinery is an income too. So your total income from here is 5,800. And total expenses, first of all, your cost of sales is an expense. And how to find out the cost of sales? The difference between sales and gross profit. And to that, you have to add tax. So the tax for the year is 1,200 minus 800. The difference of that, the tax is 400. And the operating expenses should be what? Operating expenses here. Yeah, the gross profit is 2,100. To that, you have to add the other income. And from that, you have to minus the profit before tax. Then you are getting the operating expenses as 1,500. So the correct answer should be the total expenses 4,300. And then they ask in the other comprehensive income and the total comprehensive income. So when you are going to find out that the gross profit is 2,100, nothing change over there. And other income you have to add here 600. And the operating expenses you should minus here 1,500. And now there are some adjustments because here this is the surplus that you generated from revaluation of machinery for the second time, right? And this machine was uh, was revaluated earlier and got the revaluation deficit. So from this year's revaluation surplus, you have to written off the last year's revaluation deficit. So which means it should deduct it from other expenses, and that means it should add it to the profit, right? And the tax is 400. Then you are getting the profit 1,100. The total revaluation surplus is 700, and that from that 700 you written off last year's deficit 300. So the remaining surplus should comes under other comprehensive income. Then you can get the total comprehensive income as 1,500. So the correct answer for question number 17 is answer number 2. 18. Which of the following statements is correct as per the LKS 2 inventories? And I already uploaded the whole theory parts about standards that can come for your first paper. Right? The cost of inventory should always be calculated based on a cost formula. That's not correct. The loss arising from the written down of the inventory to be net realizable value is recognized as an expense in the period is over. That's correct. And the assets which are held for the sale in the ordinary course of business are considered as inventories. So, yeah, so the B and C are the correct statements as per LPS 2. Question number 19, Janaka PLC was incorporated on 1st of April 2022. The company is fully financed through ordinary share capital. The following information has been extracted from the books of accounts of the company for the year ending 31st March 2023. And then they are asking at the end, what is the amount of net cash flow generated from the operating activities for the year ending 31st March 2023 as per case 7. So cash flow from operating activities, the cash sales is given here, and that is cash inflow. And then payment to creditors, cash outflow. And then operating expenses is 1,100, but this 1,100 includes 500 depreciation. So that should deduct, and your operating expenses is a cash outflow as well. And the income tax paid is cash outflow. And the debtors closing balance is 900. So you did credit sales 3,600, while the debtors closing balance is 900. So which means Debtor receipt from the debtors, you receive 2,700, and at the end, your operating equities cash flow is 1,800. 20th question, AMA PLC purchased a machine costing 3,600 on 1st of April 2020. And on this date, the useful life and the residual value of the machine were estimated at 8 years and 400,000 respectively. The useful life of the residual value of the machine were reviewed on 1st of April 2022. Accordingly, the originally estimated useful life and the residual value of the machine were revised as 6 years and 600. Then what they're asking the depreciation for this year, right? So when the remaining useful life changes, you have to find out the carrying amount on that date, and that carrying amount you should divide it from the remaining useful life, right? So here, this was purchased on 20th for 1, and the opening date of this year is 22 for 1. So for there are 2 years already, and as per the old cases, 3,600 residual value 400, and then divided by 8, and then again multiply by 2, then you can find out accumulated depreciation up to 2024 1 is 800. And the carrying amount on 2024 1 is 3,600 minus accumulated depreciation 2,800. And now the originally estimated useful life is 8, and that was reviewed as 6 years, right? So from that 6 years, it's already passed for 2 years. So then the new remaining useful life based on new estimations is 4, right? And then 2,800 minus the new residual value 600, and that carrying amount you should deduct it by the remaining useful life 4, then you can find out the current year depreciation as 550. 21, they are asking what are the adjusting events as per case 10 events after the reporting period. And here the financial statement for the year ending 31st March 2023. And these are authorized for issue by directors on 20th May 2023. A court order was given on 1st of May 2023 to pay 600,000 as a compensation in relation to a case filed against the company, right? And the provision for compensation 800,000 has been recognized already for the statement of 31st March 2023. And this uh, court order was given before authorizing the financial statement. So which means you can adjust this because this already did a provision. So which means this case happened in our financial year, the considered financial year, right? Then you can adjust that. A debtor of the company was declared bankrupt on 10/5/2023. The amount received from the debtors is 600,000. So these also can adjust, I think. Yes. So after adjusting, they're asking the profit, right? Correct profit, yes. So these two you can adjust, right? These two you can adjust, and the profit before the year ending is the after profit before these adjustment events is 3,500, and from that the provision of compensation is 800. But now you know the correct provision, right? So the provision that they made is 800, but the correct provision is 600. So they did an over provision. So 200 you should add it to the profit. So 3,500 plus 200, now 3,700, and from that you should minus that 600 bad debt from the debtors, and then you can get the correct profit as 3,100. 22, which of the following statements are correct as per case 37, provisions, contingent liabilities and contingent assets. And contingent assets should not be recognized in the SOFP. That's correct. Contingent assets you should disclose from a separate note, but you can't recognize that as in SOFP. Provision should not be recognized for future operating losses. That's also correct. And is that correct? Yes, that is correct. Contingent liabilities are recognized in the SOFP only when there is a possible obligation. That's all. That's incorrect. So the correct answer should be A and B only. 23 about ratios. They are asking quick access ratio and inventory residence period. So here the inventory is given as in opening date and the current liabilities and current assets are given as in closing date. Current assets includes inventory 6,500 and prepaid expenses 2,500 and cost of sales for the year ending is 36 million. Assume that the working days for a year are 360. So to find out quick ratio, you have to divide quick assets by the current liabilities. So quick assets mean from the current assets, you should exclude inventories and prepayments. So your current assets as in closing date is given as 15,000. And from that 15,000, you should exclude inventory 6,500 and prepaid expenses 2,500. And then you are getting the quick assets, and that quick assets you should divide up by current liabilities. Then you are getting the quick ratio. And to find out inventory turnover, no, they are asking the inventory residence period, right? Yes. So inventory residence period is equal average stock divided by cost of sales, and that into 360. So in this case, the average stock you can find out the inventory as in opening day 6,000, 5,500, closing date 6,500. Add these two and then divided by 2. So your average stock is 6,000 and cost of sales is given directly 36,000. And here, actually, you can find out first inventory turnover by deducting cost of sales from average stock. And then that inventory turnover, from that inventory turnover, you have to divide the 360. From that, you can get the inventory obtaining. So, which means inventory residence period as 60 days. And also, you can follow up these equations as well. In the 24th one, which of the following statements are correct in relation to the management accounting reports? And the management accounting reports are prepared for the internal stakeholders. That correct, yes. And it is not compulsory to follow up accounting standards. Yes, that's correct. Management accounting reports are prepared whenever a need arises to the managers. That's also correct. Provided only the forecasted information. That's incorrect. They are providing the previous past information as well. So only the correct statements are A, B, and C. So the correct answer should be number 2. 25th, the company which produces only a single product commenced its operations on 1st of April 2022. The cost incurred during the year ending 31st March 2023 is given as here. Variable cost per unit, total fixed production overheads, and the annual production. So what they're asking the total production cost per unit. So here you can add direct material, direct labor, and variable production overhead. They are given directly for the per unit. And then total fixed production overheads, 1,750. And that divided by 25,000, fixed production overheads is 70. Then you can find out production cost per unit. These are very easy. And 26, which of the following statements are correct as to the overheads of manufacturing company? Commonly incurred production overheads are appropriated to the cost centers. That's correct. Total overheads are the difference between the total cost and total production cost. That's incorrect. Overhead absorption rate is calculated based only on the machine hours or labor hours. No, that's correct. You can follow up the other, there are a lot of bases as well, apart from the machine hours and labor hours. But the case is, in the most papers and the past papers, they follow up the machine hours and labor hours. That's the case. So it should be only 8. 27, which of the following statements are correct in relation to the cost volume profit analysis of a product, CVP? At the break-even point, total sales value is equal to the total fixed cost. That's incorrect. So total sales value should be equal to the total fixed cost plus total variable cost. At the break-even point, total variable cost and total fixed cost are recovered fully. That's correct. The contribution and the profit are equal to each other for every unit sold beyond the break-even point. No. Yeah, that's correct. Because the contribution is sales minus variable cost. So after you covered your fixed cost, the contribution is your profit because you already covered the fixed cost, right? For 28 and 29, you have to answer from this case study. So they're asking total production cost per unit for product A and total cost per unit for product A. And yes, number of units expected to produce from A 8,000, from B 2,000. Prime cost is given, labor hours required to produce one, which is given, and total production overheads, non-productions, and total labor hours is given. The production overheads and non-production overheads are absorbed based on their labor hours. The selling price of the product are determined by adding 25% of the markup cost. So first of all, you have to find out the total production cost. For product A, prime cost divided by number of units, then you are getting the prime cost per unit. And then production overhead absorption rate. What you should do, first of all, divide this 460. Now here, overhead absorption rates for the production, it's 8. 416,000 divided by 52,000 labor hours. So per labor hour is 8. And to produce product A, they are taking 5 hours. Then you can find out the production cost. And to that, you should add to the non-production overheads as well. And non-production overhead absorption rate is 4. 4 into 5, 20. Then you can find out your total cost as 95. And for the product B, you have to go the same path and then you have to find out the cost per unit. And then that cost per unit, you should add the profit margin of 25%. Then you can get the selling price as 165. All good? Yes. The last MCQ of 2023, a company is considering two projects, namely X and Y. The duration of each project is 5 years. The following information relates to these projects, Project X and Project Y. So the purchasing price of machine is given and the transportation and installation cost, initial working capital requirement, present value of net cash flows from year 1 to 5, and net present value is given. So what they are asking, correct state. Let's see. Net present value of the project X is 916,000. How to find out that? You have to deduct the initial cost, so which means the purchasing price plus transportation and installation plus initial working capital requirement plus. So 8,500, 8,650 minus 9,566. Yes, so your initial X net present value is 960. That's correct. And the initial cash out for project Y is 7,650. How to find out that? Uh, the initial cash out for project Y. So project Y, initial cash outflow is you don't know here, but you know 948 as your net present value. So Y's initial investment is 7,975 after adding purchases, transport, and working capital. And the difference of 7,975 and the NPV, it should be your present value. So your not difference, the addition. So the present value is 8,923. So which means that is incorrect, but the C is correct. Yeah, they asked me the initial cash outflow. So initial cash outflow is 7,975, but here the 7,650. So that's incorrect, but the last one is correct. Yes. Okay. So let's see the other 20 question that you should write down the short answers. 31st, state whether each of the following statements is true or false in relation to the general purpose financial statements. So you are preparing general purpose financial statement for the financial accounting and preparing compliance with relevant accounting standards. That's correct. Prepare to meet the need of users who are not in a position to require a firm to provide tailor-made information. So that is the basic definition of the general purpose financial statements according to financial framework, and prepare based on the management's assessment about the going concern of a firm. That's also correct. And provide information about the operating result of a firm on both accrual basis and cash basis. That's also correct. 32, state whether the net impact with value of each of the following transaction on the amount of equity shown in the account equation of a trading business. Payment of a loan, installment 1,250, inclusive 600,000 interest relevant for the year. So what happened to your equity? Equity should decrease because there is an expense. So because of the expenses, the equity should decrease by 600,000. And here purchases of goods on credit with a list price of 2,500,000 subject to a 10% trade discount. And because of that, there is nothing changed for the equity because the purchases, when the purchases happens, in equations we treated that as the increase of stock, not as an expense, right? And then the trade discounts, we should deduct the trade discounts, but we do not record trade discount as an expense. So there is nothing changed to the equity from this transaction. 33 and 34, you have to answer from following case study, and then they're asking the balance of the bank statement. So this is very easy because the bank statement is given here, and to the credit balance, so which means the favorable balance, to that you have to add the check realized, and then check presented you have to minus, and direct remittances you should add, and the standing orders you should minus, and then you are getting 1,150 credit balance at the end, balance of the bank statement. And then they are asking the adjusted balance of the cash account. And that's also easy because here the cash account balance as in closing date is already given. And to that, you have to add investment income. So which means investment income that direct remittances you should debit, and the standing order payment for the loan installment and debtor dishonored, those two you should credit to the adjusted cash account. Then you can find out the adjusted cash account balance, and that is shown in debit side, right? So why these credit and debit? Because cash account is prepared by the business. So to the business, cash is an asset. So assets balances, the favorable balance is shown in as debit side, but our cash in bank and the bank statement is prepared by the bank itself. So our cash is a liability for them, right? So the favorable balance they are showing in credit side. 34, they are asking the double entry for dishonor of 200,000 check, and that dishonor from the check, that check received from a customer. So the double entry should be trade receivables debit, adjusted cash account or cash account should credit. And then they are asking the standing order payment, the double entry that for the loan installment. So installment mean including loan amount plus interest, right? So cash credit 50 or adjusted cash account credit 50, and the loan interest and the loan amount repayment you should debit separately. So loan account debit 20 and loan interest debit 30. 35, they are asking to complete the following statement with the most appropriate accounting concept. The concept provides the basis to recognize debtors and creditors in financial statements of a firm, and to that you can write down accrual concept. So because of accrual concept, you are identifying debtors and creditors. Why? Based on the accrual basis, whether the sales happens on debit or credit, we consider that as sales. So when the credit sales happen, then the debtors are incurred, right? Same as for the creditors. When the credit purchases or cash purchases, that doesn't matter. The total purchases we identify in the income statement. So when you're identifying credit purchases, then creditors are popping up, right? So that's why the debtors, creditors you are identifying through accrual basis, sorry, accrual concept. And the dividends paid to the shareholders is presented as a distribution of profit in the statement of changes in equity in line with entity concept. Based on the entity concept, we treated the owners and the others are as in a separated party from the business point of view, and we are doing accounts from the business point of view, right? See, the concept provides the basis to recognize provision for liabilities. So provision for expenses and the liabilities and uncertain timing and blah blah. It's uh, it's based on prudence concept. And the revaluation of the proper plant and equipment at the fair value is an example for the deviation from historical cost concept. Right? 36, and before that, I already uploaded the discussion of the concept for the entire 13 concepts. Go and watch that video as well. Complete the following sentences equation in relation to the preparation of financial statement of a manufacturing business. Cost of raw material lost due to fire is recognized in the income statement. We do not record the stock damages in your manufacturing account. We treated that as an other expense. So you are recording other expenses in your income statement. The work in progress inventory is valued at prime cost or total production cost. But with the syllabus update, they are asked to recognize work in progress stock always to the production cost, but it can identify either prime cost or the total production cost based on the production fee. Operating raw material inventory plus raw material purchases minus closing raw material, you can find out the cost of raw material consumed. And opening finished goods plus total production minus, yes, from that you are finding out what? Cost of sales. 37 is about the subscription, and then they ask in the subscription receivable as in closing date and the total subscription received for the year ending 31st December 2023. So to find out the total subscription received in cash, I do that through the subscription account, subscription income account, right? So the opening receivables is 40. So that is opening debit balance, and the opening received in advance is 30. So that is the credit balance, right? And the total income, whether you received in cash or not, there were 300 members, and the subscription fee per month is 1,000. So for the year, it should multiply by 12. So the total income for this year is 3,600,000. And that 3,600,000 you should debit to this subscription account, and then you have to find out the subscription receivables at the end. And it says, as in opening date, there were 30 members receivables, and from that 30 members, 20 members paid for arrears and for this year's totally. But for the other 10 members, they didn't pay for last 2 months for of the last year, which means 2022, and the entire year for 2023. So from those 10 for 2022, there are 2 months receivables, and for 2023 for the entire year receivables. So the subscription receivable total should be 140,000. And recording all opening balances, the total income and the receivables at the end, then you can find out by balancing this subscription account, the cash received for subscription, right? 38, they ask asking to state whether each of the following statement is true or false. The partnership cannot be carried out without an agreement. That's false. You can start a partnership by verbal agreement or uh, the other thing is acting. The maximum number of partners is limited to 20 members as per partnership ordinance. That's incorrect. That was limited from 2007 Company Act, not from the Partnership Ordinance Act. The goodwill of the partnership adjusted only when a new partner is admitted. No, it can adjust whenever you want, right? And as per the Section 24 of the Partnership Ordinance, the partners are entitled to receive 5% interest per annum. So that's correct. For the existing partners, it is 5% that based on that from statement 24, section 24. But for the retired partners loans, 5% is stated from section 42, right? 39, they are given the information about Ravi and Sadhun partnership, and then you have to record those information in your current account. And the opening balances are given, the salaries and interest on capital are given, and then the salaries reimbursed is given. So salaries reimbursed, you should debit to the current account, and then the closing balances are also given. So from those, you can get the total of the debit side, and it should be equal to the credit side as well. So the missing information is what? Profit. So both to Ravi and Sadhun, the profit share is 900 and 900. So they ask in the first thing the profit share of Ravi, and that is 900, and the total profit appropriated to Sadhu. You are appropriating your profit through appropriation account in three ways: interest on capital, salaries, and then after all, share of profit. So when they ask in the total profit, you should add interest on capital, partner salaries, and profit shares as well. So when they ask in the total profit appropriated to Sadhu, in Sadhu's column, salaries, interest on capital, profit share, these three you should add together. And when they ask in the total profit for Ravi and Sadhu, salaries, interest on capital, profit share, all these cases, all these three you should add, right? 40, the financial statements are normally prepared on the going concern concept assumption. The right that has potential to provide economic benefit is defined as economic resources. The two factors that are considered when selecting measurement basis, and yes, so those are relevance and faithful representation. State whether true or false. The right issue of shares leads to an increase in both the equity and assets of the company. That's true, because right issue means you are issuing share for your existing shareholders by receiving money, cash, right? The cash received with the applications of a share issue is directly credited to the share capital account. That's incorrect. You have to credit that for the temporary account, that can be share issue account or share allotment account, and then you're doing the capitalization, right? The allotment of shares should always be done on the pro rata allocation basis. No, that's false. It can decide based on the management decisions, right? And the capitalization of reserves leads to an increase in the number of shareholders of the company. That's also incorrect. When you are capitalizing the reserves, you are giving shares for your existing shareholders. So there is nothing increase of the number of shareholders, right? 42, they ask in the closing stock based on FIFO method and WAC method. So in FIFO method, the opening inventory, there were 500 meters at 2000. And from that 500, you issued here 300. And it still remain 200 up to that date. And again, you purchase 400 meters. And when you're issuing 360 meters, you are issuing that previously, the stock that you previously obtained, the remaining 200 meters for 2000, and the remaining 160 you are issuing from here. So your remaining closing stock should be 400 minus 160, 240 meters at 2,500 per meter. And cost per weighted average cost method. So that you should find from the total value of the stock divided by number of units. And that is 2,333. And at the closing date, it remained unissued 240. So 240 into 2,333, the closing value is 560,000, right? 43, policy change, estimate change. So the change of the depreciation method is the estimate change. The change of measurement basis for property, plant and equipment from cost model to revaluation, that is a policy change. The change of useful life estimate, change of cost formula is the policy change. These are very common examples for estimate change and policy change as per LKS 8. 44, they are asking the equity and how to find out the equity. You can find out equity from debt to equity ratio. So debt to equity ratio means the debt amount as a percentage of equity amount. And here the debt to equity ratio is 60% and the long-term loans is your debt. So 60% is equal to 12,000. Then you can find out equity as 20,000. And then they ask in the profit. So profit you can find out from the return on equity. So return on equity means the profit percentage based on equity. And now you found the equity from here. And 20,000 into 20%, your return on equity or the profit. Sorry, your profit is 4,000. And interest cover ratio, which mean how many times that you can pay the interest from your profit. So profit plus tax plus interest divided by interest, then 5 times. So you can pay the interest 5 times from your profit. And 45. Yes, the annual demand. First of all, you have to find out EOQ. So how to find out EOQ? 2 into annual demand into cost of ordering divided by cost of holding, right? And the cost of ordering is 120,000 divided by 3,000. There are 40 times. So then 60,000 divided by 40, the ordering cost is 5,500, right? Yes, 1,500. 1,000. So it says annual ordering cost if the order size is 3,000. So 120,000 is the annual demand, and that divided by 3,000, you have to order 40 times. And the ordering cost for those 40 times is 60,000. And to find out ordering cost per unit, 60,000 you should divide by 40. Then the ordering cost is 1,500. And then divided by cost of holding and into square feet, sorry. That is 6,000 units. And then they ask in total annual ordering holding cost if EOQ is ordered per order. So at the EOQ, total ordering cost and total holding cost is equal to each other, right? So if you order 6,000 units, so 120,000 divided by 6,000 units, you have to order 20 times. So 20 times into 1,500, total ordering cost is 30,000. And if the total ordering cost is 30,000, that is equal to the total holding cost as well, right? 46, Amara PLC is manufacturing company and its cost details at the operating capacity level of 25,000 units are used. So they ask you the prime cost per unit. So to find out prime cost per unit, here the total variable cost you can find out because it says total variable cost is equal to 60% of the total cost and total cost is given. Then the total variable cost is 4,500,000. And from that, you can find out unit variable cost as rupees 180. And that unit variable cost is equal to the prime cost plus uh, production, not production overhead, just overhead variables, right? And the variable overheads per unit is given here 70, right? So unit variable cost is 180, so that is equal to the prime cost plus 70. So which means your unit variable cost is 110. And then they ask in the total production cost. So total production cost to find out total manufacturing overheads are given here. And we found out here the prime cost per unit. So that multiply by 25,000, and to that you have to add total manufacturing, right? And non-production overheads from the total production, you have to minus the production cost. Then you are getting the non-production overheads. All good here. 47, they're asking reorder level of material A. So how to find out the reorder level? Maximum time into maximum production. And here the maximum time is given. And yes, and the maximum production is so these raw material required per unit is 10, and that 10 into 500, right? So 20,000 kilograms. And maximum stock level they are asking of B. How to find out reorder level minus minimum time into minimum consumption plus reorder quantity. And the reorder quantity is given directly 15,000, and reorder level is given directly 24,000. And the minimum time is 4, and the minimum consumption is 300 into 8. This is per raw material required per unit, and you are producing minimally 300, so that you should multiply. And the minimum stock level of C, reorder level is given directly, and average time and average consumption you have to find out. The average time is 5 plus 3 divided by 2, 4. And the average consumption is 500 plus 300 is 800, and 800 divided by 2, 400, and 400 into 6. Then you are getting the minimum stock level. 48, they ask you the total labor cost, total direct labor cost, and total indirect labor cost. And here, these two employees are, who are they? The standard production per month per employee is 800 units. And these employee number 1 and employee number 2, they are the direct labors. They are the one who are in your production. And the storekeeper is employee number 3, and that is for indirect labor, right? So indirect labor hour is 30,000. And first of all, here when you're finding out the direct labor cost, it says, and the employee is paid 100 per unit, and a payment of 120 is paid for the each unit that exceeds the standard production level. And both them, they produce 800 units. And the employee number 1, he produced 150 extra. And to that, you have to add overtime 120. And plus traveling allowance, it's 103,000. And for employee number 2, it's there is no any OT, so the traveling allowance plus 85,000. So all those two at addition, the total labor cost. And to that, you have to add here the total indirect labor cost, and then you are getting the total labor cost. 49, they are asking the variable cost per unit. So as like these are given, they are given the prime cost and the total overheads. Addition of those two, you are getting the total cost. And then you can find out unit variable cost by the difference of total cost divided by the unit difference. Then you are getting the unit variable cost. And then the contribution to sales ratio, the estimated selling price per unit is 125. From that, you can minus the variable cost. Then you are getting the contribution per unit as 25. And the contribution to sales ratio mean contribution divided by sales, so which means the percentage of contribution based on sales. So that is 20%. It's very easy, right? And then the fixed cost, you can extract that unit variable cost for the production for Jan or Feb. And I here get the Jan. So January units 8,000, total cost is 1 million. And the variable cost for that is you here find out the unit variable cost and that multiply by 8,800 units, 800,000. Then you can find out the total fixed cost as 200,000. Make a February worth, you are getting the same answer. And break even point, fixed cost divided by unit contribution, and that is 8,000. So these are very easy, right? Last one, a company is considering to purchase a machine. The expected useful life of this machine is 5 years. The estimated cash flows of these machines are given below, and they ask in the payback period. And the initial cash outflow is purchasing cost plus working capital requirement of 9,250, and net cash inflow per annum is 3,300. So first year, second year, it take, and in the third year you are getting 650 advance. So 2 years and 10 months. How to find out 10 months? The amount that you should reimburse in the next year to 650, and the amount that you are getting 3,300 and divided by 12. Sorry, multiply by 12. Then you are getting 10 months. Okay. And the total net cash inflow in the fifth year. So the normal cash flow is 3,300. Into that, you have to add disposal value and the working capital. Then you are getting the cash flow of the fifth year. And the accounted rate of return. To find out accounted rate of return, you have to find out the profit. And the difference between cash flow and the profit is depreciation. So you have to find out depreciation, and the depreciation you should deduct from the cash flow, then you are getting the annual profit. And the accounted rate of return is average profit divided by average investment as a percentage. So which means the average profit percentage based on average investment. And how to find out the average investment? Initial investment plus disposal value divided by 2. The whole workings are given here. So that's how I am discussing. I discussed already the 2023 paper. And I already upload the first paper discussion from 2019 to 2024, the latest one, and the second papers as well, both in English medium and Sinhala medium. So do your best for your A levels and all the best. And even you learn a word from this my video, please do a comment and please share with your friends as well. Jai Ho.